Well, good morning, good evening, and good afternoon to folks around the world. This is Aditya Krujekar in Medici Studio. Welcome to Weekend Wisdom. My guest today is David Nault of Luge Capital. David, thank you for taking the time.
Thanks for having me, and thanks everybody who's listening in live over a weekend. It's that kind of hustle that I think will help you achieve what you want.
So our goal here is to debunk and demystify some of the myths and some of the pitfalls in venture capital. And I remember the first time when I had a breakfast conversation with David and Kareem, I learned so much. I learned about how David looks at his craft, so to speak. Would you mind introducing yourself and your fund to David firsthand to just get going?
Sure. So Luge Capital is a venture capital firm that invests in FinTech and artificial intelligence applied to financial services. We're a fund that was started 2 years ago. We have a mix of large funds that invest in us as well as financial institutions. So we get insights from them on what they're looking for, and it helps us sharpen our investment thesis in investing in those companies. We invest both in the US and Canada. And prior to that, I was with another venture capital firm called Luge Capital in their early stage investment fund. And prior to that, I did a bunch of different entrepreneurial ventures, some of which worked, some of which did not. So I've seen both sides of the fence.
Thank you, David. Just for those in the audience here, we have a few people joining us here on Zoom, and the advantage of doing that is that you get to ask questions. We might have some time in the end for a couple of questions. So, just so you know, you don't have to ask them on video. You just have to type them in the chat, and then I will look at it and I will ask David. We are also live streaming this on YouTube, LinkedIn, and Twitter. So welcome everyone there. And this will obviously be published on Medici Studio after. So I want to jump right in here, David, and ask you about something that I have heard many times. The classic, we love your business. It's great what you've built, but is that something you do often?
It's something that definitely every VC does often. And, there are a lot of reasons why an investor can say no, and some of which are in the control of an entrepreneur and some of which are not in the control of an entrepreneur. And, not every investor, explains why they don't invest. And that's why I think the subject is an interesting subject. An entrepreneur should know that they're, 1 to 2% of the deals that investors look at, they actually invest in. Starting with the things that are not within the control of the entrepreneur is fit with the firm. And we like your business, but it's just not a fit for our firm or our investment thesis. And the earlier you know that, the more you can move on to an investor that where there's a fit. And a little tip for entrepreneurs is, you can look at their portfolio, what they invest in, the sectors, the geography, the fund partners, to get really a good sense of what they invest in. The stage that they invest in. Some investors invest later, some investors invest much earlier. So those are all things that you can look at. But yeah, the common answer is not really a fit for us at this time.
And when you say fit, I'm assuming there's a couple of dimensions to that fit, right? One of the dimensions could be that you have other portfolio companies that have a bearing on where you invest next. I mean, is that typically a consideration that you would not invest in a company which might be competitive to something that you already own?
For sure, portfolio construction is an important part of building a VC model. When venture capital firms raise money, they invested based on a sector, based on a thesis, on stage, and all of those things come into play. And successful investors invest in portfolio companies that can complement each other And investors build a network to help those companies. They build a intelligence around that sector that ultimately ends up helping the success of their portfolio. So, almost no investor will invest in competitive businesses, overlapping businesses, but really that does factor in very much so is portfolio construction in terms of fit with the fund.
Right. And I want to go back to the other piece here about the fund itself and the fact that, look, I mean, when I was a middle manager in a big company, there were some things I couldn't do because I always had a boss who would basically, he could change what I was thinking. And even when you're a CEO, you have a boss, you have the board. Now you are a board member. Do you have a boss? Is there somebody above you?
Absolutely. We are the custodians of money for our investors. And when we deploy that capital, entrepreneurs are custodians of that money that they are going to be putting to work. Every fund has LPs, limited partners, that they answer to. They need to provide returns to. So we also have bosses, if you will, that we need to satisfy.
And I think that's where what I have learned in my conversations with my VC friends over the years is that you just have to understand what is it that people are solving for, right? The founder is obviously solving for raising money, simple, right? I mean, you want capital and you want to build a business. And you are obviously solving for return on capital for somebody else. And I think there are so many different factors here, where the stage, the size, the market, the theme, I'm sure they all play into it. I want to focus on one of the cliches that we hear a lot about people investing in people, as opposed to people investing in businesses. And I want to ask the question in a negative way, just to make the point. Is there any such thing as an unfundable founder? Wonderful idea, great concept, love the business model, fantastic opportunity, but I wish this idea had come to me from somebody else other than this guy or gal pitching to me. Does that happen?
Yes, unfortunately it does. And not every entrepreneur, not every startup should raise venture capital. And I admire also those that are able to build a successful business. Back when I was in payments, we didn't raise any money, and we became a very successful company, north of $100 million of revenue, and it's continued to grow since then. Now, investors invest first and foremost in team. It is a long-term relationship. It is like a marriage, and you will hear this a lot. And to build a successful company, it takes a lot of passion, agility, and will. And so, first and foremost, we look at team, and one of the tests of a founder relationship is during the due diligence process. If things become one-sided, if the entrepreneur doesn't follow up on a timely manner, if they're negotiating terms of a term sheet and are being overly difficult, those are all yellow flags or red flags for both parties, right? You might have an entrepreneur that just doesn't feel comfortable with the investor or the partner on the deal, but for sure, we invest in great teams because ultimately, they're the ones that are controlling the ship.
Are there any unwritten rules here that VCs have that are not documented? For example, right? We always want at least one tech founder, right? We always want somebody from an Ivy League school, or we always want somebody who's done something similar before. Are there? And I understand that some of these things, just because of the sensitivity of all of us wanting to, even inadvertently not feel like we're discriminating. Are there unwritten rules in your world that people should know, or maybe don't?
I've learned over the years that founders that have that X factor, that don't fit the mold, are often those that become successful. It is not because you have an MBA from Harvard that you're not going to make it. it is not because you failed 5 times in the past that this time you're not going to make it. So, I personally never judge a founder from the get-go, no matter what shape, size, background they come from. But to your point about what are their hard skills and soft skills, yes, that's super important. Personally, I think especially in an early stage company, founders need to know how to sell. Right? You need to sell to investors. You need to sell to team members to convince them to embark on your journey, especially if you can't afford maybe the salaries that they're used to getting. So, sales is important. Sales is important for early stage traction with customers, selling them on the concept instead of necessarily the finished product. So, for sure, sales. Now, in the tech business, a founder that understands the technology, for sure, that's important. You need to be able to guide your team, and we've seen companies fail where the founder has just not been able to get a good grasp on the technology, and the tech team has not brought this in the direction of the vision and the customer needs. So, a good mix of tech and a good mix of sales, people skills, management skills. Those are all things that I think are important for an early stage founder.
Yeah, let's talk about that stage for a bit. And when I was at Verizon in a biz dev role, and Karim knows this well, I used to make fun of my colleagues on the venture side, saying that, guys, I'm bringing the deal to you fully vetted. What risk are you taking? You're not venture investing. You're just investing. I've done all the due diligence as the biz dev guy. And one of the criticisms that I hear from people saying that, the investor said that, I wish you had already a glide path for your revenue, then I would have come in. But then why do I need your money? So
I've heard that before. I've heard that from founders saying, well, I need your money now. I'm not going to need it later.
Yeah.
There are investors that have an appetite for very early stage investing when things are completely unproven. And there are investors that have an appetite for a little bit later on. And every fund is different. Some will invest in seed, pre-seed, just a concept. Some of them will invest when things are a little bit more proven. But one recommendation to entrepreneurs is that always keep in mind that one day you might need growth funding, or you might need funding at a next stage. And sometimes funding is really about accelerating growth. And there are businesses and entrepreneurs that can make it with little money. But once there's a trade-off between dilution and there's a trade-off between going quicker. So, I think entrepreneurs have something to gain sometimes by raising money, accepting a little bit more dilution, and going faster. There's a lot of reasons why a business can fail, and all of those reasons are valid reasons for an investor to say no. You can't do every one of the deals that you look at, and you got to have comfort around the sector, around the team, around the thesis, around the market. There are a lot of things that come into play there.
And I think just as with anything else in life, I think there's always a reason why people do anything, right? You may not understand it at the time, but from that person's perspective, there is a reason, right?
Mm-hmm.
And it's a valid reason.
And to that point, there's I believe a lot in the why a founder is doing something and not necessarily what they are doing. Mm-hmm. What is driving them to want to go and solve this problem? We backed a founder in cybersecurity for financial institutions called Flare Systems. And this founder lived the problem within a financial institution and did not have the solution, and was so compelled to develop one that he left his job and went and actually started the solution. And I love those kinds of founders that have lived that problem before, and really they're passionate about trying to make it happen. Because at the end of the day, it is very difficult to build a company. And when things get very, very difficult, you fall back on your belief and your mission and your drive to make this happen, because it is deeper than just the what you are doing and the financial gain.
So we talked about the stage, we talked about the team, but obviously the business and the team sits in the environment you are in, the market you are in, right? How big of a factor is the market fit, so to speak? How do you characterize that in your decision to say yes or no?
Yeah, it's a good question. You'll hear this from investors is, I like the business, I like you, but I just don't think the market is big enough. And mind you, investors don't have a crystal ball, but we try to rely on data, on industry insights. I mean, for us, we speak a lot to financial institutions and understand the pains that they have and how big that pain is. And is it a vitamin or a painkiller for them? Is it a priority for them? And is this a potential to be, a massive company in a massive market? And you look at geography and you say, is this a business that can compete not only geographically, but worldwide to build a large company? My partner came from PayPal, right? And Zoom, which was acquired by PayPal, a worldwide solution. So those are the kinds of businesses that return big for investors. And when you look at the venture math behind a venture capital fund, a lot of companies do not succeed. So you need really a few that outperform that will return the fund. At the end of it all, the power law of there are a few companies that will return the whole fund. So in order for that to happen, it's got to be a massive market. It really does. And a tip for founders is really help the investor understand your numbers, right? Why you believe that this is a big market, and more so on the big market is there tailwind in the industry, right? Is this a rising market that will lift all boats, right? So there is when you've got headwind and you're fighting against the market, the more the market is growing, the more likelihood you are to succeed, and the more room there will be for you. And, it's not because that there's competition that investors will not necessarily invest. Sometimes it's validation on the opportunity, but can you capture your share of the market in a large market? And eventually, are there acquirers for that business as well? Because it's one thing to get into a business and invest, but it's another thing to exit and get out. So, the bigger the opportunity, the more likelihood of the deep pocket and acquirers for that business down the road. So for sure, the market size is an important factor.
So with everything that we all do as data-driven analytical people who want to use a lot of our left brain in making decisions, there's also the right brain. And in the spirit of making all my guests a little bit uncomfortable, I'm going to ask you this, right? Have you made investments where you were probably not fully convinced about the data and what that was telling you, but you knew there was something else? Maybe it was momentum, maybe it was FOMO, maybe it was just, I know there is something here. Do you do that?
So whenever we make an investment, there are lots of unknowns, and we have to get comfort over those unknowns. We're not in the venture capital business because everything is proven, but you try to align, the risk with the reward, and that this entrepreneur is going to solve these problems or prove out these problems. And investors often reinvest more capital along the way. So you might make a first check, and unfortunately the company does not succeed. But in the way in which a venture capital fund operates is that you want to double down on the companies every step of the way that continue to outperform. So to that point, not everything is proven at the beginning. However, the thing that speaks loudly for sure for entrepreneurs is traction does remove doubt. But the later that we get in, the more we're going to pay, right? The less we're going to get in return. I mean, you invest $1 million check in a $4 million business is different than investing $1 million check at a $50 million valuation. So, you got to weigh that as an investor. We're an early stage investor investing in seed and Series A as our sweet spot, and then we'll continue to reinvest in those companies. But sometimes too, the business is just too early, right? It's interesting, but it's still there's a lot of things that are fairly unproven that we can't get comfort over. Will the company be able to build a product? Will the product work? Will the technology work? Will customers even accept it? Will you be able to beat out maybe some of the early competitors in the market? And so, founders have also a vested interest in showing some of those proof points, because then they will also get a better valuation. So it works on both sides as well. And we've had, businesses that have approached us as, listen, I just want you to make you aware of what we are doing, and I'm going to come back and see you once I've done this, and then we can talk. And that is a strategy of a founder to start getting interest, building their pipeline of investors, but going out and proving a few things. And contrary to maybe 10, 15, 20 years ago, building a startup requires often less capital, at least to start proving some stuff, right? So with cloud and with open source and with some of the tech around there, somebody can prove out what they're doing. So for sure, there's traction will remove doubt, but there's also FOMO is a real thing, right? Maybe not every investor will say it, but when you see a founder that you believe that they will succeed with or without you, it's always attractive to be making sure that you are on top of that deal. And not every stage you will invest, and you got to build that investor needs to build that relationship with that entrepreneur, because at the next phase you want them to choose you, because outperforming entrepreneurs have the choice of money that they want. Investors will try to sell you on taking their money. So if you built a good relationship with the entrepreneur, you've been able to help them, and that's something that we try to do as well, is even though we might not be ready to write the check today, we try to help them so that they think positively about us at a next round of funding, or when they are ready to raise funding, introducing them to a customer, introducing them to talent, to advisor, maybe introducing them to another investor that invests maybe a little bit early, or an angel investor. And we see that partnership being played amongst VCs as well, where a later stage VC might say, hey, I really like this founder, I like this business, a little early for us, but why don't you take a look at it? And that referral goes a long way as well from a trusted investor or entrepreneur saying, I like this, I want to write a small check inside of them. And then we can invest more later on. But the little tip for entrepreneurs is you want to try to convince them that your train is leaving, and they need to get on it, right? So the keeping them up to date, feeding them with information, progress on how things are going. You got to look at this as an evolving relationship as well with investors, future investors at the next stage, but also current investors in your pipeline.
And some people might not realize that just as a good founder with a good sales mindset is very focused on the CRM, the sales pipeline. Similarly, good VCs have a CRM. You have a pipeline, right? You are proactively working that pipeline, which leads to your portfolio, right? How often do you go back to the no's in your pipeline and convert them into a yes on your own accord?
Yeah, we are just like an entrepreneur, with their customers and building their pipeline. We do as well. We've got well over 1,000 companies that are actively inside of our own deal flow, and so we want to keep up to date as well. So we will reach out and outbound entrepreneurs that we maybe haven't spoken to for a quarter or two. We'll put them on our track list to see their progress of how they're doing. We'll create touch points to get an update with them. we will try to, demonstrate our value as well by introducing them to different people inside of our own network. So we do build the pipeline, and we do follow up with entrepreneurs to make sure that we're there at the right point in time.
And is it always that you have to initiate the conversion, so to speak, of okay, I should ask it a different way, right? You have a pipeline of 1,000 deals, or right, 1,000 opportunities in your pipeline. A good founder, a good entrepreneur who's raising money probably has a pipeline of, I don't know, maybe 50, right, VCs in his list of people that he should be reaching out to. Is it always true that it is the founder who's pinging the investor multiple times, keeping him up to date? Look, here's what's going on. Here's how I've made progress. Can we talk again? Or have you seen that in your experience now shifting, that the VC is also checking in a bit more often? Is that balance shifting over time?
So there are funds out there that are very, very good at this, that will have a whole team that does outreach to entrepreneurs to build that pipeline. And we definitely outbound entrepreneurs. When we think about a sector that we like and we don't have a company in that sector, we will scan the market and we will find entrepreneurs and we will reach out to them. And it's a inbound and combination of inbound and outbound. The likelihood of doing a deal on a cold call, email, or a form filled out on a website is highly unlikely.
Right.
But, for entrepreneurs, the better, if you can get a referral to an investor, you go up on their priority list. Investors can be sidetracked by so many different things: fundraising, helping companies, exiting, in the middle of a financing of a new deal or an existing company. And when a trusted entrepreneur or a portfolio CEO or a co-investor says, "Hey, Aditya, I think you should be looking at this opportunity," it goes a long way, and the follow-up obviously is much quicker. So those referrals, I'd say the likelihood of a deal is an outbound, a referral, somebody that we've seen at an event, we've seen them pitch, they came from a trusted accelerator or incubator. So those are all sort of the hierarchy of interest level of a company.
We have a question here from Luis about investing in a particular sector. So I'm just going to ask you a more general question. As you look at where we are today, both in terms of the space, FinTech, that we are all focused on, as well as the time we are in with everything going on around us, are there particular sectors that are more interesting to you than others, like wealth tech? Is that an interesting sector for you? Are there any others top of mind that you're looking at right now?
Yeah, good question. The new reality of the market has shifted a little bit the priorities for investors and of course for customers as well. So the sectors that are for sure of interest is investing in today's market when the market might be going down. There are tailwind in that industry for using more data to better understand how the market will react, the likelihood of performance of a portfolio. But if you think of insurance companies too, is especially because of COVID, there's very little face-to-face that is happening in insurance, right? You can't go in somebody's house and take a blood sample and ask them for their health check. And so there are sectors like that have tailwind, but there's also another piece of this whole thing is that I think what today's market has done also for investors is it's amplified the way in which they look at companies. So the companies that have proven maybe a few more proof points, companies that have a little bit more customer interest and can show that in today that there's even more upswing, and we're seeing businesses that have more upswing. I mean, you think of cashless payments, contactless payments. We made a very small check in a company called Tip Tap Payments. All about accepting payments without necessarily touching physical money. So you're seeing an increase in those kinds of businesses. But wealth tech is a sector too that we're seeing. The aging of the population, trying to make sure that they have enough money for retirement. Everything digital, the digital transformation. This whole situation has become a digital reality check for financial institutions. And they put to test a lot of the products that they have out in the market, how people interact with financial services. You don't walk into a branch, at least you don't want to walk into a branch if you don't have to, and that's put some strain on the technologies. And so they're looking also at technologies that can help them innovate much quicker.
We have a question here from Taran about early stage investing that you have done or you do. I mean, what's the earliest that you've invested? You do seed stage, and what would be some metrics that allow you to decide, even at such an early stage, that this is the right thing for you to do?
Yeah, thanks for the question. We invested in a company in New York called Till, which is a bank for kids. Pre-product, we invested just really on the idea. So we've invested checks way at the beginning. We've also invested checks when there's been $1 million and plus in revenue. There's no minimum check for us. We will invest very early on, but of course, the more that the team can prove that they're able to deliver a product, that they understand the market, they've done their research, the more proof points that they have, of course, the better likelihood it is of getting funding. There's a lot of ideas out there, and so we will invest in, especially in a sector that we have a thesis on, that there are almost no players inside of it. So we will invest in those, especially early, because we can't find a company yet that's building that. So we will invest in a team that has that vision. Right.
We'll take only one more question here from the audience. It's from Onur. It usually takes time and a full product of companies in regulated industries to get approval from regulators. And it needs more capital than most founders' ability to bootstrap. Do you still require traction for such companies? What's your approach in general? I don't know how you want to answer that, but figure it out.
Regulatory is a two-sided situation where if you can get past the whole regulatory, you've got defensibility, because not everybody can get through that. At the flip side is also a risk, because there's a probability that you might not, and you could be stopped. So in some of those businesses, once again, I mean, it's in general, all businesses, you can invest very early at a lower valuation when things are not proven, and it's all about getting comfort over those things that are unproven, versus a little bit later when things are proven. Personally, we have an appetite for early stage companies, but there's also something to know about a fund is the later that they get in their fund cycle. And when I say fund cycle, is a fund is 10 years. The first 5 years they make new investments. Second 5 years they reinvest in the best companies. They don't make new investments. They raise another fund, right? So the later that you get in your investment period, the less likelihood you are of making an early stage investment. So entrepreneurs should also understand where the fund is in their investment cycle. And the first year they'll be making very early bets. The fifth year they'll be making a little bit of later bets. So it's all about having appetite at the risk, and the entrepreneur being able to prove that they're cognizant and they have a way of which they're going to address that risk. And if the investor is comfortable, the check is written.
Right. I'm going to ask you one last question here, and then would love your closing remarks before we wrap. Have founders said no to you?
We've had, for sure, we've had investors, entrepreneurs that have decided to choose another investor. We've also had deals that we've won, maybe at terms that the valuation was not as high as another investor, but they wanted to choose us because of the value that we could bring. But it's a good point. Entrepreneurs can also say no, and they should also say no sometimes when it goes against everything that they believe in, and they just don't feel comfortable with that investor. Optionality for the entrepreneur is a good situation to be in. You've got the choice of different investors, and the more kind of term sheets, the more interest you have, the more you can choose the right fit. But it's part of the game too. Is not every entrepreneur is going to choose you as an investor. You got to prove your value too. We sell ourselves also in deals that are highly competitive and that we want to get in. If the entrepreneurs can creating a competitive process, they're in a very good situation.
On that note, I want to thank you again. I think it's about communication in both directions, being true to what you're solving for as an investor and being true to what you're solving for as an entrepreneur. And you both have valid reasons to say no to each other. I think that's the competitive investment marketplace, I guess, that we live in. David, thank you so much for sharing your thoughts so candidly. What we're going to do here for those who choose to read what was said is David has very graciously written up a blog which covers all of the points that we have covered today, and we'll be publishing that on Medici in the coming week. So look out for that. And I want to also thank my friend and your partner, Karim Jilani, for making this happen. With that, David, thank you for visiting us here on Weekend Wisdom.
Thank you very much. And thank you to all the entrepreneurs and the people that joined. Feel free to reach out to us. Luge Capital on Twitter, David Nault on LinkedIn, and all of our other social channels, and luge.vc, Luge.vc. Thank you.
Thank you.
Thank you.